Hey again. This video is going to be about the memo of Fitbits. There's quite a bit to go through, so I might be able to catch it in 15 minutes. If not, it'll be 2 videos. But let's get straight into it, shall we? So the best way, as I zoom in here so we can see it all, there we go. The first question asked about the deductibility of the what you use to repair the pool. The key things to speak about here, we're quite clearly looking at section 11D, repairs. We have to ask yourself, has there been damage? Yes, there has. There's a hole in the system. Is this damage a part of the whole asset, or is it the entire asset? And the key thing here is that it wasn't the entire pool, it was just the filtration system. The next question, does it restore it to its original condition, or does it improve it? Because restore to original condition is a repair, but an improvement is not. Now the issue is, well, we can't use the original item, or it's become very expensive. So we should be able to use the cheapest alternative. Our intention quite clearly here was to just repair. It wasn't to improve. But you could argue the other way and say, well, it actually did improve, so regardless, it's not going to be allowed. I don't know the answer, but as long as you're arguing one way or the other, that's fine. The key thing, also, you're not forced to use the cheapest option. So the fact that we spent the 68 and didn't take the option for the 59, that's totally fine, because we're looking for amounts that have been actually incurred. It doesn't have to make a difference what somebody else offered, provided you meet the requirements for section 11D, which is why in this case the 68,000 will be deductible, unless you wanted to argue that because it improved it, then it won't be deductible because it's actually improved the asset. You'll see there that's a mark per point, okay, except for the top one, which is half a mark, and the bottom one, which is half a mark. In total, that would be 5, but you also have the communication mark. Very often, the communication mark is simply given for not talking nonsense. So, provided what you're saying makes sense and it follows the right argument, that's what the communication mark is going to be for. You lose that when you say things like, it meets the requirements of 11D, therefore it's not deductible. Or when you say that it's both, or something like that. That's how you lose marks under communication. Okay. We then move on, and we come to the point whereby we had the gym buildings. I think that's fine. What happened here was we had the original building, and we replaced it with a new building. Okay. Now, the first thing to remember is you're going to have the allowance on the old building. That allowance is going to be 5%. You can claim it because when we made that building was new and unused. Okay. That building was then destroyed though, so we're going to have to work out recoupments and CGT. The first step is proceeds, and in this case it was insurance payout, if I remember right, 4.5 mil. But that's going to be limited to cost when looking at the recoupment. And then we also have to look at the tax value. Remember, the tax value is the remaining allowances still to be claimed. So you can work it out using your fingers and counting to see how many years we've had it for. Remember here, part years count because your 13 quin is not going to be apportioned. What you get in this case is a recoupment of 1.92 million. But in this case, we have a building. The building was destroyed. We replaced it with another building. We used the proceeds to purchase the new building, different to what we had in Baratheon in the last video. So in this case, we can use section 8.4e to defer the recoupment. Now you're going to defer the recoupment over the new asset. Okay. So what we've seen up until now is always that this recoupment is going to be deferred, and you'll write it off as you write off the new building. But here's the key thing here. The new building can't get a 13 quin because it's not new and unused. It was previously used as a restaurant. So you've got to tell me that, firstly, to show me that you know there's not an allowance. But that's also going to have an effect on the release of the recoupment. And the release of the recoupment here will only happen when you sell the new building. So basically, you're not going to have any release of this through the life of the new asset. It's only going to happen when you get rid of the replacement asset. So actually this is quite a good thing. Okay. Then we have the situation of the treadmills and the exercise bikes. They were new ones that we bought. They're going to be Section 11E assets. And you need to look very carefully at how many months you had each of them for. Now, for most of them, you would have had them for 9 out of the 12 months, if you count it, and it's over 2 years. That's why we have this first portion being the 12,000 we paid each times by the 99 times over 2 years and over 9 out of 12 months. But what you need to remember is one of them we got rid of earlier because it was destroyed. So that asset, that one treadmill, we only actually had for 1 month. So here's a situation whereby you have to be quite clever how you do this. You're going to work out for 9 months on the 99, but you're going to work out for just 1 month on the one treadmill that was destroyed. Remember, it's a disposal event, so you're going to have possible CGT and recoupments. In this case, your proceeds are very low. Your tax value is still quite high because the only thing you've deducted so far is the 500. And in this case, that's going to be a Section 11O. Remember, that is deductible. It has to meet certain requirements. In this case, it does. So that amount is going to come off. The exercise bikes, what is key to remember here is that each of them cost less than 7,000. Therefore, they're all written off right away. What this means for the one that was you sold it to a customer, you're going to have proceeds limited to costs. Your tax value is going to be 0 because you've written it off completely, which means you're going to have an 848 recoupment of 5,000. Okay. Linked to this, don't forget about it. I'm going to the bottom. You're going to have CGT. And you're going to have CGT on all 3 of these items. First item being the damaged building. Remember, that's the old building. You're going to have proceeds being your full proceeds less any amounts which have been included or are going to be included. And in this case, the recoupment of 1.92 mil is going to be included in the future, so you take it off. The base cost, what you paid for it, less all the allowances you've received. Okay, these two amounts will pretty much always be the same, except in very select circumstances, like the 1.92 that you take off of both. And that gives you a capital gain of 1.3 million. But remember, Para 65, because we have the replacement asset and we're using 84E, you're going to defer the capital gain as well. On the treadmill, you've got your proceeds of 800, quite low. Your base cost, same as before, it's what you paid for it, being the 12,000, less the 500 allowance that you've claimed. But here's something new, less the 10,700. What is this? It's the Section 11O. And remember, base cost as defined is what you pay for the asset, less any amounts deductible. And that 10,700 is deductible, so it needs to come off of your base cost. It's pretty much like an opposite recoupment, if you want to think of it that way. You've also got the exercise bike. Remember here, your proceeds were 7, your cost was 5. That is your recoupment and your allowances. They net off and you have a gain of 2. Those are the only CGT things we're going to have so far. You stick them in at the rate of 80% because it's a company. There's no annual exclusion, so please don't put one in, and that amount will go in. Just remember, it's only the 2,000 because this is deferred. We're now going right back up to the top. Some other stuff to remember. The office table, you get the allowance over 6 years that you would claim. You'd carry on claiming that because you had it for the full year. But you also have the moving costs. Now you need to claim the moving costs over however many months are left still on this asset. If you work that out, it should come to 66 months, and 9 of them occur in the current year. So that is what you do as a deduction. Awesome. Sales, don't forget, I actually think no, it's fine, it's still coming later. These are the sales on the 12 months contracts. You just needed to speak about 2 points, basically what accrued last year but was paid this year, and what was paid this year but didn't accrue. What I need you to show me, something that was paid this year but accrued last year would have been taxed last year, so it shouldn't be accounted for, and something that you've received this year should be counted for tax purposes. Now, you could have done this either way. You could have started with cash received and switched it around, or you could have started with revenue and switched it around. Either way, you should have come to the same answer. But what I care about is the two explanations. You needed to explain both points to me. For the sports shop, you've got your gross income and your purchases. Those were given, so they're half marks each. You've got opening stock, but remember, if you get stock for no consideration, it's included at opening stock. You can't get a Section 11A because you didn't pay anything for it, but SARS does allow you to put it into opening stock. You also have to remember, we gave the t-shirts to a PBO. PBO, those t-shirts are going to be recouped at cost and put in. You can't get the Section 22.8 proviso because it was given to a PBO. So it's not in the use of trade, but please remember the Section 18A that's going to happen later. Okay. Remember, you gave something to a PBO. They are Section 18A, so don't forget about that later. Closing stock is given, but you also have the write-down of shoes. The only important thing to do here is just to remember to reconcile between the total write-down or the write-down per pair. Don't get those two things mixed up. Employment costs, it's always the gross amount, never the net amount. Okay, gross amount is expensed and gross amount accrues. Any employee's tax is simply just a prepayment of tax for each of the parties giving it to SARS. Cool. Then we get onto the fringe benefits. Now, I find this very cool and very interesting. Probably interesting enough that you get to see me on camera again. What we need to speak about here is you've always seen situations whereby when something is a fringe benefit, you're dealing with the individual who's getting it. But start to think a bit about what about the company that owns those assets or gives those assets. If a company pays its staff, you've always called it a Section 11A. If a company buys a car to use in the company, it's always been a Section 11E. It doesn't change when you give it to an employee. Whether you're paying them a salary or a fringe benefit, it's still going to be deductible. If you buy a car and you're using it in your business, whether you're using it for deliveries or you're using it to compensate a staff member, it's still Section 11E. You still have a car that's used over time. So that doesn't change. So in this scenario over here, when you bought the car to give for use by Mrs. Semenya, it's still going to be an 11E in your business. When you paid the Bravery Award, it doesn't make a difference if that amount is reduced or not a fringe benefit or whatever it might be, because that's for the individual. In our case, we paid $7,500. That's the end of the story. So we get a Section 11A. It was paid for trade, no other questions asked. All those things you've learned about fringe benefits and reduced by 5,000 and looking at the kilometers, that's for the individual. The company's not going to know how many kilometers the individual drove, so it's not really of use to them. Okay. Other things that are interesting, the low interest loan given to the staff member. Again, they're going to have a fringe benefit on their side, but think about what's happening for us. We gave somebody a loan, we earn interest, therefore it has to accrue. So that interest income comes in for the 6 months that we had it. There's no exclusions because we're a company, not a person, not a natural person. So that's where you leave it. The long service award, once again, whether it's reduced by 5,000 or anything like that, it's for the individual. We don't care about it. What is interesting is the severance benefit. Now, I've said it's not in the production of income because that person's no longer working for us. So by paying it, we're not getting any benefit. It's not part of our trade. It's just a nice thing we did for someone. So this is going to be not allowed as a deduction. When it might be is if it's part of your policy. So if you staff members expect this and know it, and when they retire, you're going to have to pay it, then it becomes part of simply your costs of doing normal business. So in that case, it would be deductible. Okay. The last thing you need to, the last two things quickly, so I can sneak it in here, is the answer from above, your 68,000, as well as your Section 18A deduction for the things that you gave to the PBO. Once you've done all of this, the question asked for the amount of tax, so you have to multiply by 28%. Okay, add that up, comes to 40 plus your one communication. No, that was for above, but I think that's pretty much the right amount. I've got 3 seconds, 2, 1, the video is done.